Okay, good morning. I guess it's our last day of class today, so we're going to do a couple things. First of all, starting to review about the exam again. Again, the exam, the posted hours are 9 a.m. for the lab on Sunday. We're going to come in early, so we're opening up at 8. So if you're taking the exam on Sunday, the computer lab will open up at 8. And you have to finish your exam by 6 p.m. on Tuesday. If you're coming in to the computer lab to take to get the bonus, you have to, or on ProctorU, you have to submit your exam by 6 p.m. on Sunday. It has to be submitted by 6 p.m. Eastern on Sunday. And we do open up at 8 o'clock. Now, just something to mention. If you're coming in to take your exam in the computer lab, Haley and I will both be proctoring. When we're there, we cannot answer questions about the exam. I cannot answer a question about, well, what does this word mean, or what does this question mean, or is there a problem? I'm there solely as a proctor, so I don't mean to not help you, but we're not going to be answering questions. Also, I will not, absolutely positively, will not discuss your grade with you when I'm proctoring. Okay, it's not going to happen. So we are there proctoring. We'll have a smile for you, but I'm not going to be able to do anything other than proctor. It's not fair to people that take the exam at other times, and it's not fair to other people to be talking to. So just know that we are there proctoring. Sections 3, 7, and 8 schedule with ProctorU soon, and you do get this 10-point bonus if you submit your exam by 6 p.m. on Sunday. So, something new today, but it will not impact the vast majority of you. Today we're grading Learning Catalytics accuracy based. Before you get nervous, it's okay. I'll tell you how it's going to work. Haley, whoa, that's mine. Hold on. Here we go. Okay. So today, Learning Catalytics is accuracy-based. I'm doing this as kind of an experiment. You will not be harmed today if you're in class and if you're paying attention. But you only get credit for the question if you get it right. We're going 50% accuracy today and 50% participation. So let's say you got every single question wrong today, you would still get 50% of the credit for today. So, but that said, I'm going to be going over answers as well. So if I deliver a question twice, the second time I deliver it, your answer. So if a lot of people get a question wrong, I may administer the same question again, and your second answer overrides your first. So just know that. So we're just going to go forward, and you'll see it will be okay as long as you're here and you're paying attention. You will get the questions right. So, but this is the whole class today. It is accuracy-based. It is 50% participation, so you get some credit even if you get it wrong, but to get full credit, you have to get it right. So the first question that's out there, and this is in Learning Catalytics right now, how do you get the 10-point bonus on the final exam? We've had this question every day for the last 2 weeks, and we just went over it, so everyone should be getting this right. Now, when I'm looking at people's answers so far, we do have 3 people right now who have this question wrong. Okay, so you may want to look carefully, make sure you've got the right answer, and just in case you don't have the right answer, it is B. It is finish the exam by 6 p.m. on Sunday. So you need to make sure that you've answered that. The question will be open for another minute or so you can get that answer in, but make sure you answer it. And I will be reminding you every time we have a question today that it is accuracy-based, but you will be fine as long as you're here and you're paying attention. I don't anticipate any difference there. So again, this question is going to stay open for a little while longer so you can still get your answer in. And we do have one person out there still with the wrong answer. So you may want to make sure your answer is right, that you have the answer that you're thinking you have. Okay. And again, that's going to stay open at least till I get through the announcements for today. Okay, what's due Saturday, December 6th, the Chapter 13 homework and Exam 3 info quiz. The Exam 3 info quiz, just 7 multiple choice questions. Everyone should get 100%. And just a note, all of the homework is due this Saturday. There are no extensions available on it. Homework will be closing Saturday night. There's no extensions on Chapter 13. The Chapter 12 homework will be due at the you can't do it any later. All homework's done by Saturday night this week. Section 3 also has a regular quiz in addition to the exam info quiz. Okay, and just to reiterate what to expect during finals week, I'm going to add that 10-point bonus to the scores on Sunday evening. So Sunday night, you'll see that 10-point bonus show up. It will not show up when you finish your exam. It's not there until I add it. Your lowest 3 quizzes won't be dropped Monday. They'll be dropped Wednesday because I have to wait until all the practice exams are done. I guess I should fix that. We'll do it now. Okay, so your lowest 3 quizzes will be dropped Wednesday or late Tuesday night, somewhere in that range. I'll send out an announcement once that occurs, and I will be working on grades Wednesday and Thursday, and I hope to have all the course grades entered in Flashline on Thursday. And again, if you email me and say, can you bump my grade up because I'm only X% away, I'm not going to have that conversation with you because I will not adjust one person's grade. If you are point whatever away from the next highest grade, keep in mind that there's other people as well. If I adjust anyone, I'm adjusting everyone. Everyone will be treated exactly the same. And believe me, I am looking, and I am looking carefully. So I will not adjust individual people's grades. Okay, and so I am looking, and I will get grades done as soon as I can. Okay, accounting majors. If you're an accounting major, I'm a scholarship coordinator, so this is actually on my mind now. I'm working on this. We have scholarships. The Department of Accounting awards pretty much as many scholarships as the entire College of Business. We have scholarships available for students who have finished this class and typically gotten an A or A minus. Once in a while, someone with a B plus with a lot of other things can squeak by. But if you're in a position where you're an accounting major and you finish the course and you've got an A or an A minus, you should absolutely positively be applying for a scholarship. Generally, the scholarships at this level range from $500 to $1,500 in that range for next year. And then as you go forward as an accounting major in future years, then once you make it through managerial accounting and Corp 1, then the scholarships those years range from $1,000 to $4,000 a year. So we have a lot of scholarship dollars, and rule of thumb, you generally want to have the highest grade point you can, but certainly over 3 for sure, maybe 3.25, 3.3, but certainly if you're above 3.5, you're a very strong candidate. So do keep that in mind. I'll be sending an email out to you if your course grade is pretty high. You'll see this email appear. Sometime early in January, applications will be due February 1st. So do watch for that, and don't say, oh, I'm not going to apply for it because I won't, and my chances of getting it are slim. Well, if you get a good grade in this class and you have a decent GPA and you're an accounting major, your chances of getting a scholarship are very high. So do watch for that email. Okay, and for those of you online who do not have audio or video, this is Haley today wearing the reindeer antlers. So I guess everyone in Beta Alpha Psi. Okay. Oh, is she talking about the practice exam? So, Pat, the exam you're talking about is not the one with only, okay, Pat, there's two exam, there's a practice exam, and that's on My Accounting Lab, and that's due before you take the exam, and you've got the 7-question exam info quiz that's due this Saturday, and both are available. Okay. Okay. As a reminder, today Learning Catalytics is accuracy-based. You should be putting in your, if you haven't, answering the first question. It's going to close very soon. Today it is accuracy-based, and I can tell you if you're sitting in class here or if you're online and you're paying attention, you will get everything right today. So that should not be a problem, but it is today. If you answered everything wrong, you would get half credit. So it's half participation, half accuracy. I need to do this as we prepare for next semester. Okay. Okay, so we're going to finish Chapter 13 today. And again, do we have a question coming up next? Okay. Our next question relates to what we did on Monday. So this one, think about your answer carefully, and again, you're going to be okay. Which of the following is typically used as the base in a vertical analysis of a balance sheet? So when we're talking about a vertical analysis, that means everything on the balance sheet is divided by one number. And what's that one number? Is it total liabilities? Is it cash? Is it total assets? Or is it gross sales? Thinking about the balance sheet. So give it a shot. Okay, so on this one, which of the following is typically used as a base in a vertical analysis of a balance sheet? We have total liabilities, cash, total assets, gross sales. So you're thinking about a balance sheet. Right now, looking at those answers, there's one answer, that a number that's not even on a balance sheet, so you can eliminate that one. We're going to close this question in about 10 or 15 seconds. So make sure you've entered your answer. Okay, so this is, you might even want to look at your notes from Monday. Again, we are accuracy-based. Okay, we're going to close this question right now. Now, right now, 58% of you got this right. Now, this was stuff we did on Monday. Which of the following is typically used as the base in a vertical analysis of a balance sheet? You would do total assets. When we have a balance sheet, you're dividing everything by total assets. If you have an income statement, everything is divided by sales revenue or total revenue. Okay, now we're going to administer that question again. You have one last chance to get it right. You have to get it, this answer is going to count. So are you pushing this question out again? Okay, so same question again, answer it. This is your chance. If you got it wrong, well, either way, you need to answer it correctly. Okay, we're going to close the question in about 10 seconds, so make sure you've got your answer in. Right now, we are running at 92% correct. I was hoping that would be 100% correct. And on this one, you're going to, one more. Okay, how close are we on? Okay, 5 seconds, last chance. Okay, close it. Okay, so total assets was the answer. You should absolutely know total assets is for balance sheet, revenue, sales revenue is for income statement. When you're doing these questions today, you have to answer if we do it twice. Some questions we'll only do once, and you don't know going into it if it's going to be one that we do once or if we do twice. And accuracy matters, and if you pay attention, you should be fine. Okay. So we have another one here. Again, reminder, I have this up on every question in case someone's coming in late. These are accuracy-based today. Okay, on a common size balance sheet, so we've got the balance sheet. This is vertical analysis they're talking about. Common size statements are vertical analysis. Income tax payable is expressed as a percentage of what? So balance sheet, vertical analysis, basically what is every item on there divided by? Okay, common size balance sheet, income tax payable is expressed as a percentage of what? Okay, 5 seconds left on this one. You need to make sure you answer it. Don't close it. I'm going to go forward. Well, yeah. How close are we? Close it without revealing. Okay, this one. On a common size balance sheet, income tax payable is expressed as a percentage of. Now, a lot of people are getting this wrong. We'll do this one over. We're not going to do all of them over today, just so you're banking. So let's talk about this. When we just did this last question, I want to go back to this one. This is not a question out there right now. Which of the following is used as the base in a vertical analysis of a balance sheet? Total assets. That means every single item on a balance sheet in vertical analysis is divided by total assets. We did that question, you got that right. Now, keeping that in mind, let's go forward here. Redeliver this question then. This question is asking the same thing. It's saying on a common size balance sheet, which is vertical analysis, what is everything divided by? Everything being income tax payable or whatever. This is the same question. So answer it again. Okay, on a common size balance sheet, income taxes payable is expressed as a percentage of what? Another 5 seconds. Okay, close this form. Did you close it? Okay, it is total assets. Okay, so let me talk about this. There's some debate going on about getting credit for today. First of all, you get 50% participation credit. So if you got every question wrong, you would get 50% anyway. To earn the other 50%, you have to get the question right. You have to answer every question. In the case of when I ask a question twice, the first time, if you're participating, you have to participate. You have to put an answer in. But you don't know when you're answering that question the first time if I'm going to do it a second time or not, so try to get it right the first time. If the percentages are too many people get it wrong, I will go over the answer. Like in this particular one, I basically gave you the answer on the second try, went back to this one, and the answer was total assets. And this second question is exactly the same question, just worded differently. So you will get credit if you get the answer right on the second attempt. The first attempt, all you need to do, well, you need to try to get it right on the first attempt. If you change your answer in mid, like as it's closing and it didn't get your changed answer, your first answer is still there. So you haven't wiped out your first answer. So it's basically pay attention as we go. I will give you the answers as we're going, as long as you're paying attention. So let's just go forward. So yes, both answers were total assets. Okay, so we'll see that as we go. And we're over 90% correct on these, so we should be good. I had the right answer the first time. Yeah. Well, and keep in mind, we did it a second time, so the second time you answer it, it overrides. The second question overrides anyways. So, okay. So let's go forward. Statement of cash flows. This one I just want to say a couple things. We had the statement of cash flows back in Chapter 12, and we looked at analyzing various statement of cash flows. There are certain signs that point to this company being healthy. First of all, the cash from operating activities is greater than the company's net income. Secondly, most of the cash is generated from operating activities. Okay. The third one, investing activities. Your purchases of things are more than your sales of things. If you see a company and they're selling off assets, that can be alarming. If they're selling off assets to raise cash, they cannot sell off assets indefinitely. They're going to run out of things. And then financing activities are not dominated by borrowing, that they've got stockholders putting money into. So those are signs. These are not, if a company doesn't have one of these signs, it doesn't mean they're unhealthy. These are just things that are indicative of a healthy company. Okay, now the next thing I want to say is exercise 13.4. I've done a how-to video on this one. It's 2 minutes. The video is about 2 minutes long, so I just want to point out that that is out there. I did it yesterday, so 13.4 is out there. I was afraid we'd have too much in class today, so that one I put out there. Okay, another reminder. So now we have a true-false question. And give it a shot on your own. The percentage change in financial statement balances is computed by dividing the dollar amount of the most recent period by the base period dollar amount. We are not closing this one yet, but I want to talk about what the right answer is. So this is your heads up. I'm talking about the correct answer because so many people have it wrong. This is one of those ones where, and like in real life, one word can make a huge difference. This is one where one word does make a huge difference. This one's actually false. You divide the change by the base period amount. So the question says dividing the dollar amount of the most recent period by the base period dollar amount. That's saying you divide this period's balance by last period's balance. That's not what it is. When you're doing these percentage change, you divide the change by the base period amount. So this one is false. We're going to be closing this question in about 10 seconds, and we are not administering it again. And I've given you the answer again. This is another one where you get the answer. Right as of this minute in time, 91% of people have the right answer. Okay, the answer is false. There is no tricks. You need to make sure you've entered false and submitted it. We will not do this a second time. Okay, again, this answer, we are going to close it in 10 seconds from now. So Haley, you can tell me, you can close it in 10 seconds. And the answer is false. Right now we're about 90% people correct, 95%. And that isn't meant to be a trick question. This is meant to be reading carefully. When you're signing contracts for things, when you're analyzing things in real life, it's not just accounting. One word can make a huge difference. And this is part of that. Ooh, you know, pay attention to every word. This is not meant to be a trick. Okay, did you close it? Okay. Okay, so now we're going to do short exercise 13-6. Short exercise 13-6 is a quick little exercise, and we're doing a ratio here. I want to come back to this. This seems to be out of order. Okay. We're going to come back to this. We're going to talk about ratios and come back. So the rest of the book, the rest of the chapter, the rest of the course is about financial statement ratios and using these ratios to make business decisions. We're going to go over a ton of ratios today. And I wanted to tell you about 3 pages in your book, pages 775 to 777 in your textbook. List every ratio that we're talking about today and more information beyond that. And I've got an excerpt here. I did a page grab, and it lists the ratio, then it shows you the formula, and then it gives you a little explanation of what information is provided. These 3 pages are huge. It's pretty skinny. You could fit, even though it takes up 3 pages, you could fit this on your reference sheet, because you can squeeze it together. There's a fair amount of white space there. So we're going to be going over these ratios today, but I would definitely put them on my sheet, including what they're used for, because I can ask questions all the time about what kind of ratio something would be. So pages 775 to 777 in your textbook have these ratios. Okay, if you have the e-book, go to those pages. Those are great pages, so I did want to just point out those. Okay, so we have 5 types of ratios. You need to know which ratios are under which type, and those 3 pages that I just pointed out back here, they group the ratios by those, so they go in the same order. So we have the ability to pay current liabilities, we have measuring turnover, measuring leverage, measuring profitability, and analyzing stock. So we're going to start with that measuring ability to pay current liabilities. There's 3 main ratios that we look at, and those will be working capital, current ratio, and quick ratio or acid test ratio. So what we're going to do first is we're going to go through each of those. The first one's working capital. Okay, working capital is not a ratio, it's a number. And it's basically your current assets minus your current liabilities. It'll measure your ability to pay current liabilities with current assets. And then this larger better, meaning everything else being equal, the larger your working capital, the better. That's the direction you want to see working capital go in. You want to see it get larger. Okay, now, so that's working capital. There are 3 of those ratios designed to measure if you can pay your current liabilities or not. The next one is the current ratio. The current ratio is taking the current assets divided by the current liabilities. The higher, the better. Just rule of thumb, you want this one to be as large as possible. The larger, the better. And if it's getting larger, that's a good trend. Okay, and then the third one is the acid test ratio or the quick ratio. And what this does is it's kind of like the current ratio, but it doesn't include as many assets in the numerator. It says, okay, let's just look at the assets that can easily turn to cash. It doesn't include, for example, inventory. And it shows the ability to pay our current liabilities if they all come due right away. How much cash can we get right now from things that are readily turned into cash very easily? Okay, now we're going to do 13.6 because now it's in the right order. So this is an exercise where we need to compute their quick ratio and look at the three companies. Okay, so we have to compute this company's ratio based on their balance sheet. So when we do a quick ratio or acid test ratio, we're going to use the formula of cash plus short-term investments plus receivables divided by total current liabilities. Just as a reminder and just as encouragement, the PowerPoint slides are available on Blackboard. They have what I've got here for like the different ratios. They have all the ratios on them, and they actually have some extra information on them as well. So you may want to pull those just because of the extra stuff on them too. Okay, so the acid test ratio or the quick ratio is this cash plus short-term investments plus receivables divided by total current liabilities. So in the book, it gives us the balance sheet for this company. So what we need to do is go through and pick out those things on the balance sheet. So we have cash, short-term investments, and receivables. So those are our numerator, and our denominator is total current liabilities of 1.2. Total current liabilities of 1,227, giving us a quick ratio of 1.2. A quick ratio of above 1 is considered to be pretty good. Now it asks us to do the same exact thing for 2013, which this was 2014. So we do the same thing for 2013, and we're going to take 2013's cash, short-term investments, receivables, divide by total current liabilities, and we get 1.07. Okay, so what they wanted us to do in this problem is compute this company's ratio, quick ratio, for 2014 and 2013, and then we take that we just did, and we're looking at these other companies, and what we see, the ratio looks strong because it's above 1. So their 2014 ratio is above 1. It's been above 1. It's moving in the right direction. And when we look at all the other companies for 2000, the companies in the green box, they all have lower quick ratios. So this company looks pretty good for two reasons. Its quick ratio is going up, which is good, a good trend. It's above 1. I guess there's 3 reasons. And it's better than its peers. So just from those reasons, we would say this company looks like it has a pretty good ability to pay its current liabilities. Okay, we're going to do a question now. Okay, just as a reminder, 50% participation, you have to get it right, but you'll be good. Okay, a firm's ability to pay current liabilities, so this group of ratios, can be evaluated using working capital and the current ratio. Are both of those items part of the ability measure our ability to pay current liabilities? True or false? I'm not closing this question yet. Right now we're running around 79% are getting it right. We're only going to do this question once, but I want to go back to one of the slides we had. Okay, ability to pay current liabilities is measured by using 3 ratios or more. And those 3 ratios are working capital, which is a dollar figure, current ratio, and the quick acid test ratio. So as we look at this question then, okay, a firm's ability to pay current liabilities can be evaluated using working capital and current ratio. Is that true or false? It's not asking, are these all of the ratios available? It's saying, are these 2 part of that group? Right now, 86% people have the right answer. I'm not doing this question again, so make sure that you have your answer as true. We're going to close this question in about 10 seconds. And right now, when I'm looking at this, we have 93% of you with the right answer. It is true. There's no trick here, and I'm not doing the question again. Okay, 13.5 will be recorded. It will be available. It's doing more of the ratios that we just did. So 13.5 will be available no later than tomorrow morning as will 13.7. I don't want to do this one. Okay. So we've got a couple homework problems, a couple more recordings will go up. Next up, the turnover and cash conversion cycle. To measure how much we're turning over our inventory, for example. We have 5 ratios that we can use. We use inventory turnover, accounts receivable turnover, days sales outstanding, accounts payable turnover, and cash conversion cycle. All of those are used to measure our turnover and cash conversion. Turnover, if we have a business and we're selling inventory, this is a preview of this. We want to keep selling that inventory. We don't want it sitting there for a year. We want to sell the inventory as fast as possible and get more inventory in and more sales, etc. So we want to turn things over. We want to shorten up the amount of time it takes us to get cash from the time we buy our supplies until we get cash from our customer. So this is all about churning our sales. So now what we're going to do is we're going to go over all 5 of those ratios. Again, pages 775 to 777 will give you all of these ratios, but these are the 5, and we're going to go over each of them individually now. Okay, so the first one, inventory turnover. Inventory turnover is the cost of goods sold divided by average inventory. So cost of goods sold divided by average inventory. It's a number of times the company sells its average level of inventory during a year. So it's just saying how many times did you turn that inventory over in a year. This is going to vary widely depending on the kind of industry. If I'm talking about perishable food, if I'm talking about a grocery store, they better have a high turnover, a high inventory turnover, because their stuff's going to spoil. So a grocery store is going to have a very high inventory turnover. On the other hand, a jewelry store doesn't turn over its inventory nearly as fast, so it's going to have a much lower one. So this is industry dependent. Also, you would like to see your inventory turnover on increasing. The higher the turnover, the better, all other things being equal. So you want to see this to improve. This one would be going up Okay, you want it, if you see a company that has inventory turnover that's decreasing, 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 that's an indication it's having trouble selling its inventory. So high inventory turnover is what you want. That means you're selling your inventory. It looks like you're not having any trouble selling your inventory. You want a high inventory turnover. Okay, next up, the next one is days inventory outstanding. And this takes 365 days in a year and divides by your inventory turnover. And it basically tells you how many days on average it takes to sell your inventory. Okay, so days inventory outstanding, 365 divided by the inventory turnover, it's basically saying how many days do you need to sell your inventory on average. And again, this is part of that category of turnover and cash conversion cycle. Okay, next up. The third one, accounts receivable turnover. Accounts receivable turnover is measured as net sales divided by average net accounts receivable. So you're going to take your net sales, divide by your average accounts receivable, and this measures our ability to collect cash from our credit customers. And the higher, the better. Rule of thumb on this one, you want this one as high as possible. Okay. So we have this one that says, okay, our accounts receivable turnover, how many times a year do we collect our accounts receivable on average? And then you want that one to be higher. You want to keep collecting. You want your collections to keep coming in. You want to collect cash as fast as possible. So what we do with this then, to make it a little more understandable and make it more relatable, is we take this accounts receivable turnover and we use it when we calculate the next one, which is days sales outstanding. 365 divided by the accounts receivable turnover. It's abbreviated just as turnover, but it's accounts receivable turnover. It's how many days it takes to collect the average amount of receivable, the average receivable. So this is how long does it take for you to collect your receivable on average. If you're selling on collection terms of 30 days and this number 60 days, that means customers on average are taking 60 days to pay you and not paying attention to the terms of the contract. So this is how many days. Everything else being equal, you want this one to be as low as possible. You want to collect in as few days as possible. So you would like to see this one lower. So in this whole category, what we're doing is we're looking at how long it takes us to sell our inventory. We're looking at how long it takes us to collect our receivables. And we're also looking at how long it takes us to pay our own payables. And the next group coming up after this one, I'm going to pause for a minute until people quit writing, and then go on to the next subgroup within this category, which are the payables. How fast are we paying our own liabilities? Okay, so now we look at accounts payable turnover. Accounts payables are what we are paying, our current liabilities, and we take our cost of goods sold divided by our average accounts payable, and this is the number of times per year that the entity pays off accounts payable. And basically, we're trying to get this number because we're going to use it in the next ratio. So this one is, okay, how many times a year do we pay off our accounts payable? Doesn't make a lot of sense. We want this one, in theory, we want this one to be as high as possible. But we use this number in the next one, which is basically saying how long it takes us to pay our liabilities. Okay, so in this one, we're taking 365 dividing by the accounts payable turnover. So this is how many days on average it takes us to pay off our average accounts payable. If you see if you see the days payable increasing, that means it's getting harder for us to pay our bills, and that's alarming. So you want to see this one's one you want to see short, just like the days receivables you want to be short. You want to collect your bills quickly, and you want to pay your bills quickly. Now, there's 3 areas that are in this whole cash conversion. We said this category was turnover. So we're looking at turnover of inventory, of accounts receivable and accounts payable, and converting those things into cash. Inventory we pay for, customers pay us, and we pay our vendors. So we have this cash conversion. So we take those days that we just calculated. We have the cash conversion cycle is known as our days inventory outstanding plus our days sales outstanding, subtract our days payable outstanding. So we have this how long on average it takes us to collect money for a sale we've made. So the cash conversion cycle is in number of days, and it refers to, it's a interrelationship of inventory, sales, and payables. So we have this interrelationship of how fast. Cash conversion cycle, we want it to be as short as possible. We don't want it to take all year for us to collect our money. We want this one to be as small as possible. Okay, we have a question coming up again. Oops, well there we did. You got a flash preview of it. A high inventory turnover may indicate a company is experiencing difficulty on selling its inventory. A high inventory turnover may indicate a company is experiencing difficulty selling its inventory. True or false? Okay, on this one it's still open, but I want to make sure we've got 78% correct, so you need to correct it if you've not. We want high inventory turnover. High inventory turnover means that we're able to sell our inventory, and we're selling it again and again and again. That indicates we are able to sell it. If we had a low inventory turnover, that would indicate we're having difficulty selling inventory. So the answer for this question is false. If instead it said a low inventory turnover, that would be true. But for this question, the answer is false because a high inventory turnover ratio means that we are able to sell our inventory. We're going to be closing this question in about 5 seconds, so make sure you get your answer in. We are not doing this question again, so this is your one chance to get it right. And it's given on the screen, so make sure you have false entered as your answer. Okay, now to the third group of ratios. The third group of ratios, overall ability to pay debts. We have 2 ratios in this group. We have the debt ratio and the times interest earned ratio. These are referred to as leverage. The definition of leverage is your ability to pay, overall ability to pay debt. That's what this category stands for. And when we talk about debt, this is all debt. This is not current liabilities. That first group we were talking, the current ratio, the quick ratio, and working capital, that's all focused on current liabilities. This category refers to our long term. Okay, and our short term. So the first one, debt ratio. Debt ratio is simply total liabilities divided by total assets. And it looks at what percent of our assets, total assets, are we financing with debt. The higher this ratio, the greater the pressure to pay interest, to pay and principal back. Okay, so our debt ratio, total liabilities divided by total assets, this percentage of assets financed with debt. The reason that the higher this is, the more risky it is because with debt becomes the responsibility or the legal obligation to pay principal and interest back. And so the higher the debt ratio, the more principal and interest the company has to pay back. Okay. And then the other ratio in this category is the times interest earned ratio, which says let's take our income from operations and divide it by our interest expense and see how well we can cover the interest expense on our debt. Okay, and then those are those two categories. We have a short little exercise just computing those two ratios. I've posted that to YouTube, so if you need it as you're going through the homework, that one is on YouTube already, 13-8. And now we're going to get into the next group. Okay. Measuring profitability. There's lots of different ratios for measuring profitability. And again, this is where that list that you have on pages 775 to 777 comes in handy. I'm going to go through each one of these. So if you don't have this written down, that's okay because we're going to hit each one of them in order. So we're going to start with the gross margin percentage. So we have 9 of these, and they all measure profitability. So measuring profitability is the top of every slide. That's telling you what category this is. Gross margin percentage is the gross margin divided by net sales. That's it. This is saying what percent of every sales dollar comes back to you as gross margin. Just as an aside, when you're talking about gross margin is your sales minus your cost of goods sold. Okay, we had that earlier, but just wanted to mention that. But gross margin is what percent of every sales dollar comes back to you as gross margin. So that's the first one. The second one is operating income percentage, which is operating income divided by net sales. And this is basically another measure of profitability, saying what percent of every sales dollar ends up as operating income. I want to go back to this overall picture here. Okay, we have these 9 ratios. The DuPont analysis method in the upper right-hand corner, I don't have a slide specifically for it because it was very, very long and involved. But the DuPont analysis basically is taking a leverage ratio and another return and breaking those two down into the pieces. So we're not going to specifically cover the DuPont analysis other than to know it exists. So next up is the rate of return on sales, the net profit margin ratio. And this is saying, let's take our net income, subtract our preferred dividends, which is basically saying how much net income is available to common shareholders, and dividing by net sales. Okay, Asset turnover ratio is our net sales divided by our average total assets. Okay, and this is the amount of net sales generated for every dollar we have invested in our assets. So we would want these ratios when we talk about profitability, we want these to be higher. Higher is better, all other things being equal. And again, I would encourage you to download the PowerPoint slides because I've got the slides and I've got a little more explanation on each one. Or alternatively, you can go to pages 775 through 777 and have summaries of all of these. Okay. Rate of return on total assets, abbreviated as ROA, is the return on sales times the asset turnover ratio, and it's how profitably we use our assets. You know, with these slides, as I'm sitting here going, this is a lot of writing. I'm going to flip through the rest of them. We don't actually have a homework problems per se with these, but I do want you to have the ratios. So after class, Haley, why don't we summarize the ratios? Maybe you want to even type them, and we'll email them out, okay, so that you've got them. Because I'm going to flip through them, but it is a lot of writing, and I want to make sure that we don't end up writing the whole time. Okay, the leverage ratio is the average total assets to average common stockholders' equity. And again, we're going to email these out shortly after class, after the second class today. And earnings per share. Okay, so then we have one last group of ratios, and again, these will be on the sheet we email out. Price earnings ratio, the dividend yield, and book value of common share. Again, I'm going to put those in this email that I'm sending out, but I want to get to the limitations of ratios because I'm afraid we're going to run out of time. Okay, so we have the PE ratio. We'll be emailing this out. We have the dividend yield on common stock, and we have the book value per share of common stock. So we will send those out. What I want to do is talk about the limitations of ratio analysis. Ratio analysis, we can compute numbers for every single company, but they are just numbers. If you look at them just by themselves, they don't mean anything. Like if you go to the doctor and have your blood pressure taken, that's some indication, but it's not the whole picture. And you have to look at the whole picture. You have to compare a company to its peers. You have to compare a company to itself over time. So ratio analysis is just numbers. There's also other things that are important about a company that may not show up in its ratios. For example, its stance on human rights may be very important, but that doesn't show up immediately in its ratios. Its impact on the environment may be quite important, but that doesn't show up. So ratio analysis does not show us everything. The question about are a lot of these formulas going to be on the final, I would make sure that your sheet had the formulas listed on there because I don't think the emphasis on the final is going to be on computing them as much as interpreting them, like know what goes into it. A good indication of what's on the final is to take that practice exam and do it over and over. Alternatively, be in study plan. That will give you a very good idea of the type of questions that will be on this. But I would certainly put the formulas on my sheet just to be safe. Okay, when you're analyzing financial statements, looking for problems, red flags that might pop up at you are if the company's doesn't have any earnings or has lost the last few years or last year. Decreased cash flow. You look at the statement of cash flows and they're not getting the cash in that they did before. Operating cash flows maybe are really low. That's a red flag. That a company has too much too much debt, inability to collect receivables. You see the receivables getting, the turnover slowing down, the days getting longer. Build up of inventory, seeing inventories build up, and then looking at the sales, inventories, and receivables ratios. Okay, now here's another example of the type of question you could see with respect to these ratios. Okay, ratios that test liquidity include all the following except. So we went over the liquidity ratios. The debt to total assets is the only one of those that doesn't refer to liquidity. And liquidity is a measure of how easily we can pay our current liabilities. So that first group where we're talking about the ability to pay current liabilities and the conversion, liquidity is this turnover kind of. So debt to total assets does not fit with those. So the answer on this one is going to be D, debt to total assets. So liquidity is those first two groups of ratios. It's going to be the current ability to pay current liabilities or the turnover cash conversion ratios. Okay, you want to get your answer in. We're going to do one more question. Okay, you have about 5 seconds to get your answer in here. This one we're not going to do again. Right now, 94% have this answer right. We're going to do that. Okay, so 5 seconds and she's going to close this one. Okay. Okay. And one last question. It feels like there should be a drum roll. This is our last question for the semester. The ratio that provides an estimate of the number of days on average that it takes for customers to pay their account is the what ratio? Let me look here. Okay. Okay, the ratio that provides an estimate of the number of days on average that it takes for customers to pay their account is what? Right now, it is the day sales and receivables. This is the number of days it takes on average for our customers to pay us. So we would want to, that would be the answer. A would be the answer. The current ratio is liquidity. Accounts receivable turnover is not the number of days, as is its asset test ratio. Okay, so you want to get your answer in there. Right now, 86% of people have it right. It's going to be open for about another 10 seconds, so make sure you get your answer there for A. Okay, just as a reminder then, take away here for the end of the semester. To get the bonus, you have to complete the final exam by 6 p.m. You have to submit it by 6 p.m. Eastern on Sunday. Haley and I will be proctoring on Sunday in the computer lab. We will not be able to help you with questions when we're in there, nor can we discuss your grade Sunday because we're there to proctor. I am going to do my best to get grades completed Wednesday or Thursday. So in Flashline, you will see your course grade. Until I get everybody's analyzed, I'm not going to adjust an individual grade. So I'm looking at everyone. I will treat everyone exactly the same. So good luck with your future classes, and have a nice break after finals. You want to close that?